Okay, hello, I'm Ted Leverette, the original business buyer advocate. I'm not a business broker, never have been. And in case you don't know it, decades ago, I bought the wrong business and I bought it the wrong way. And then I took about a year to at least try to learn how to buy the right business the right way. And then I did 12 more acquisitions, and all of them I sold for a profit. And that was about 30 some years ago. Since then, more than 100,000 people worldwide have relied on my books, my trainings. Some of them have hired me. In fact, about 1,000 people have over the years. I've trained 298 independent advisors, and they're serving buyers better than they used to. We're going to cover some of the biggest gaps for deal makers. It's a good idea to anticipate these gaps well before you face them, and to know exactly how you're going to bridge them, because dithering, when facing these gaps or incorrectly proceeding, will most likely kill your deal. The good news is you and we can control the marketplace. The better you control the marketplace, and I'm talking about the variables here, the variables, the more likely you'll achieve a done deal sooner in any kind of marketplace. Big poster. There are phases we all go through in deal making, and then there are people who influence them. I call them the deciders. So those are the variables, and there are hundreds of them. Today, we're going to talk about a few. We're going to talk about the people and the processes, but I want you to keep in mind, it's the deciders. They influence all the phases, and they influence one another, whether you know it or not. These are the people who have a say in what you do, what you want to do, what we do. They affect what you accomplish, and you cannot easily control some of these people. Well, such as the people facing you on the other side of the deal-making table. Advisors, for example. Okay. The key here is you can and you should, in fact, you must have more control over advisors and everyone on your side of the deal-making table. That's how they get admitted to your side. If you don't have control, then you're giving up control, and it's your life, your money. That'd be a very naive thing to do. So to do that, you have to select the right people, the right kinds of advisors, the right lender, etc. All those deciders, those that are on your side of the table, be careful who you pick. They need to be compatible. They have to be team players. Because if you don't, you can expect them to incorrectly influence you. And guess what? That results in a dumb deal or no deal. Okay, so I'm going to start with a gap. This, I think, is the mother of all gaps. It's the most frequent deal-making gap. It's when expectations collide. It's the first bump in the road. And that upset happens because people underappreciate the importance of expectations management. When you don't control expectations, you invite your first loss. Guess what it is? Lost income opportunity. You see, lost income happens when people irrationally defer completing an M&A transaction. And that causes at least two kinds of losses, and both are avoidable. Number one, you miss out on the best opportunity that you're probably going to get. And number two, lost income. That's the money you would have earned every day, week, hour, month, the longer it takes you to what? Complete your deal. Here's the spoiler alert. Lost income is never found. So does anybody have any comment on our panel about this idea of if we don't get the expectations aligned up front, particularly on our side of the deal-making table, we're going to have to cope with them then under the fire of trying to do a deal? Okay, we're going to pass.
We agree with you, Ted.
You agree with me?
Yeah.
All right, Nancy, thank you. Yeah, this is that's kind of an obvious one. Well, but how about this one? People, you can use chat boxes if you want us to respond. Remember, video off, audio muted. This one I picked up on social media. The person who posted it, he titled it, "It's a catch-22." Catch-22. And he writes, a searcher, well, this is him. He writes, "My potential investors tell me to contact them when I have a pending deal under LOI. But what do I do when brokers won't show me confidential business profiles without first seeing my proof of funds?" And the proof of funds need to be adequate for the deal, the acquisition. Well, here's what I think. A few considerations to help you bridge the gap. Number one, brokers and some owners and sellers, not all of them, they say, "Show me your money." And they demand it because they can, and they should. And guess what? Business buyer competition lets them do that. So you're going to have to present yourself way better than other searchers. It's not just about the money. You got to showcase whatever else you have besides the cash that you're going to bring to the table to bridge that gap when a broker says to you, "Show me the money." Now, sometimes you can't show all the money. So you're going to have to be able to really pitch those other benefits you bring to the table. Another idea to help bridge this, "I can't show all the money or any of the money," is, well, look at your buyer competition. If you're trying to beat them, well, you're going to have to show the money, period. Number three, have you gone around brokers? Have you even tested the businesses for sale by owner? If the broker is the gatekeeper, game over. So you better be looking direct, unless the brokers are willing to play ball with you, because what? You will show more value than just the cash. Obviously, you're going to have the cash to do the deal, but I'm talking about in the opening moments, as this writer or this questioner asked, pre-LOI. And here, number four, hey, how about this? Motivate people to invest in you instead of a particular opportunity. That's how lots of searchers get financial commitments, and they get it up front before launching their search. Think about it. Why does an investor want to hand over money? Because they're going to trust you to find and do the deal and manage the company. So focus on that. Anybody have anything to say on our panel about this idea of having the money, showing it?
Ted, I had this situation about a year or two ago, and the way we got around it, and I'm speaking as a broker, the buyer basically got a letter from the top tier investor. So his lead investor provided a letter saying, for the right deal, I have X amount, and showed proof of funds that way. So if you're searching with a group of investors, maybe pick the biggest one and get something from them that will, in writing, that'll say, "Yes, we've got this money," or we will back this guy if he finds the right deal.
Okay.
Yeah, and Ted, if the buyer presents themselves well enough such that the seller is wanting to come and present a potential deal to the buyer, then oftentimes the seller isn't really considering those things because they've already seen that buyer as the ideal candidate.
That's a good point. Anything else?
One of the few reps and warranties that a buyer has to sign on for is that they have financing. So the legal reps and warranties come into play on financing. And the seller, of course, has 95% of the reps and warranties, but the buyers only want, essentially, is that they have financing. So it's really great, as you're saying, Ted, to have some sort of commitment in advance. And you can have a firm that'll invest in your deals, just write a general financing commitment letter so that the seller understands that you've got a backer behind you. It doesn't have to be for a specific dollar amount. It can just say that we'll back his or her deals if they're, with caveats.
Good point. I'm going to emphasize something. Buyer competition is lurking. Your strength is stronger when it's not upon you. Okay, I have one more gap and then I'm done. And this is another one I picked up off social media. It's the gap when the amount of fees that a client, have to pay that you can afford to pay is not as much as your advisors are going to want. So here was the question somebody wrote. Ted, how am I supposed to buy the best business I can afford after paying what seems to be exorbitant fees to lawyers, accountants, and others? Well, I have 2 tips. Do your homework. You won't need as much advice. Number 2, don't overpay advisors. Now, I can't speak for others on this panel anywhere else, but I'll tell you how people get guidance from me. And it's the lowest cost for me, and it's the lowest cost from lawyers, accountants, and appraisers and others. They read my books. They watch my YouTube channel. That's where they get the street smarts about finding and buying the right businesses the right way. And then my interactions with clients focuses on how they deploy best practices. We're not covering the basics. They're not paying minute by minute for the basics. And that enables them to go ahead with less frustration, and they're going to achieve a more profitable deal sooner. And guess what? They're going to pay everybody else less money. So just search for me, Ted Leverette, on YouTube and Amazon. You'll see how the smartest people do deals. Any comments on this idea of fees and homework? Okay, folks, anyone who wants to...
The fastest way to escalate legal fees and accounting fees is to have either one lawyer or both of them, buyers and sellers, not have M&A experience. This goes for accountants as well. People think that if they have only one lawyer or accountant, then that person can hold up the other side of the deal. The person who's paying for that one advisor is going to pay double or more, because they're not only doing the work of both sides, they're educating the other side, and you're even running into conflicts of interest situations.
Okay, folks, coming up, let's hear from David Barnett. David and I began collaborating on business buy-sell transactions way back in 2010. He's working from Atlantic, Canada. He's one of the few people I know who has nearly done it all. He started businesses, he brokered sales, he's raised money, he's guided buyers, and his how-to books are widely read. So David, talk to us about gaps.
Well, Ted, I have to say that as a father of young children, I sometimes buy Lego, and I know the box says it's for ages 4 to 99. And when I saw the poster for today's session, I thought, there you go. You see, Ted still uses his Lego. And so the gap that I want to talk about today is what I call the empathy neediness gap. And so if we think about the way that the brokerage industry or the business advisory industry talks to business owners about their eventual exit or sale of their business one day, we find a lot of common themes. A lot of it is about, selling your business for the highest price, getting the best value, creating the most competition, creating some kind of auction. And a lot of this commentary and discussion creates a place where it's difficult for those sellers to have an empathetic point of view to the buyer. And so they become very self-centered. They start to think about what they want and their needs. And we've all run into a case where a seller believes their business might be worth a certain sum. And then in their mind, they start to think about how they're going to spend that money. And sometimes there's a real gap there between what the business can truly be bought for, as far as what the business can afford to pay in debt service, et cetera, and what some of these sellers believe is going to be the outcome of the deal. Now, that lack of empathy is on the seller side, but then what starts to happen on the buyer's side is that if we have a buyer who hasn't established the investment in creating all the different methods and systems in creating a good deal flow. And so I meet people like this all the time who will, peruse the online business for sale websites. They may be calling the occasional broker, but they haven't really created a plan of all the different ways that they're going to exploit these different channels. And I mean, Ted, you mentioned earlier, has the buyer looked at talking to sellers, business owners directly, for example? Well, there are actually many different paths that a searcher could go down to start creating deal flow and have opportunities coming to them. And so when you are a searcher and you meet this one opportunity, it's the only one you've seen in a long time that looks good, then you come at it with this scarcity mindset, which creates the neediness. You now desperately want to do the deal because you have this feeling that the good deals are scarce and that you can't find another one and you need to do it. Meanwhile, if your seller lacks empathy, these are the things that are going to drive you to that place that Ted, and this is a term I love that I've heard from you for many years, is that buyer fever, right? It's when people get all excited about this one deal and then they think that they have to get the deal. And if there are other competitors and they have no other options, that's when they go too far. And they end up with a deal that doesn't quite work the way that it's not going to work for them. They end up over leveraged, or they end up with poor terms, or committing too much cash flow to the debt service, et cetera. And so the way that I would bridge this gap is that for searchers, one of the key things is to be educating the sellers as you meet them. And I always encourage my clients who are buyers to have as many meetings as possible with the sellers to try to create a relationship, demonstrate who they are and what they're about, and to guide that seller down a path of thinking about the process, but then also thinking beyond the transaction. And I'll tell you a story, something that one of my clients who's in my group coaching group just posted the other day. He's been employing multiple methodologies to create deal flow, one of which was to contact centers of influence. And a business in his region went up for sale with the M&A branch of a large accounting firm. And these guys do a lot of deals that are in the lower mid-market, and they tend to demonstrate or show these deals to people in private equity and strategic buyers. Well, all of the potential strategic buyers of private equity firms came in trying to show how they could offer the highest price. And when this gentleman who owned the business started asking them about what they were going to do to the business after the deal, he realized this wasn't the kind of buyer he wanted. He wanted an individual buyer who was going to help carry on that legacy and wouldn't gut the business of employees and other parts of things that he had built over time. And so my client got a phone call saying, hey, we heard that you're looking for a business like this, and our seller isn't interested in selling to these other types of people that we normally sell to. And so he's now in a position where a seller's representatives are coming to him because of the work he's done to create that deal flow. And so I would encourage everyone who's out there searching is when you're introducing yourself and you talk about yourself and talk about your vision post-deal and see how that meshes with what the vision is of the seller, you can then sometimes, ideally you get the seller to see you as a person who is just like them, but younger. And you're going to be able to best carry on their legacy in the business. And that's where you can start to reintroduce empathy into the equation, where they will start to be able to see the deal from your point of view. And then they're going to understand when you say, hey, I can't cash flow this price you're asking for. Here's the reality. Here are the numbers. If I'm going to achieve this vision post-closing, then it's got to work for me and for you. And that's when people can come together and make a deal.
David, that was a thorough presentation, and we're not going to have any time to respond to it because we're running out of time. So if you have another gap you'd like to explain in fewest words, we'd love to hear it.
No, that was it. I just prepared this one.
All right. Well, then I don't see anything in the chat box. Anybody on the panel want to talk about this lack of empathy? And basically, again, it's the misalignment of expectations.
I think it dovetails perfectly into the gap that I will be talking about, using different words and different examples, but it's very, very similar situation. Okay,
speaking of Stephen Beal and I have been sharing ideas since 2005, and he's on my short, and those of you who know me, I have a very short list of business appraisers and business brokers. He's adept at advising company owners and people wanting to buy and sell businesses. He's got an impressive record in corporate finance and banking. Stephen, what's a gap?
Thank you, Ted. It's hard to believe it's been 16 years, but yeah. So springboarding off of David's comments, what I see as the biggest gap to getting a deal done, other than say the terms and pricing, whatever, is fundamental trust and goodwill between the buyer and the seller. I'm doing deals is basically working with people. working with the buyer, working with the seller, working with lawyers on both sides, working with accountants on both sides. Buying a business is complicated. It's not like buying a hamburger from McDonald's. You're trying to buy, hopefully, a well-oiled cash flow machine that will that will provide for you and your family going forward. So I've found the largest driver of the success of the deal is the level of trust and respect between the buyer and the seller. Now, they recognize that you don't need to be best friends with the seller or with the buyer, and you are on opposite sides of the transaction, so you do have opposing views in that sense. But you do have a common goal in that you're trying to get a deal done. You need to trust the other party enough to want to do a deal with them. In sales, sales 101, it talks about building rapport. And I think both parties need to work on this and be aware of the importance of rapport in structuring a transaction. I mean, a good illustration I have just recently with COVID travel restrictions barring, well, they didn't bar interprovincial travel, but if you were crossing provincial borders, you had to quarantine for 2 weeks at some point in the recession. We were in the middle of doing a transaction. So the buyer and seller never met each other throughout the whole transaction part of the deal. And I talked to both on Zoom separately and together, and spent a fair amount of time with both parties, but they spent less time with each other by Zoom. And let's face it, Zoom isn't great for building rapport. It's great for communication, but not necessarily that type of personal thing. And as we were getting closer in the deal, and the debates got into deeper and deeper issues, we had issues where the seller would say to me, I just don't trust these guys. And the buyers would say the same thing to me. And I'm thinking, I knew both of them fairly well at this point, and I trusted both sides. Both sides were intent on doing a deal, but they didn't trust each other. And because they never had that face-to-face meeting, they never sort of sat down and shared a meal together. And eventually the deal got done despite the pandemic restrictions. And now they're working together on the transition from the seller to the buyer. And they both sort of say to me, "Hey, this guy's a great guy." Yeah, that's what I was trying to tell you throughout the process. So whenever you're trying to do a deal, try to maximize that opportunity for that personal rapport and face-to-face meetings.
Stephen, the first thing, and I know you know it, I do with my clients is we do a rehearsal on relationship building, and we practice various techniques to become the first choice of brokers and sellers. And we practice it using Zoom so that we know how to talk to people where we become likable. It really is all about relationships. Anybody else on the panel have any comment about that? Steve, you have another gap?
Yeah, or actually there's a question in the chat room about that rapport is harder to build with an intermediary in the middle. Speaking somewhat biasly as an intermediary, I think part of that role is on the intermediary to make sure that the seller and the buyer, as Ted mentioned, help coach the seller on what to say and what not to say. We have had deals fall apart where the buyer just gets, all arrogant and starts talking like he's the king of the hill, and the seller just says, "I don't want to deal with this guy," or vice versa. I mean, it works in both directions. And so I would suggest that the role of the intermediary is to help build the rapport between the two and coach both sides on issues like that.
The same person in this chat continues by saying, sourcing for sale by owner opportunities can allow for more direct contact to build those relationships. Hey, I'm not a broker. I said it at the beginning, never have been, but guess what? Brokers have a big incentive to help you buyers get a done deal. That's when they earn a commission. So if you treat them right, and as long as they know what it takes to get a deal done, it's pretty hard to have a bigger advocate than maybe somebody like me who's only on your side helping to get a deal done. So my feeling is we don't avoid brokers, but we immediately bypass brokers who don't play ball the way we need them to play and help us create a friendly relationship with sellers. Any other gaps, Stephen?
I guess the other one I had was just on seller financing and expectations. As a broker trying to sell businesses, I get a lot of calls from buyers saying, and if the first question out of their mouth is, will the seller finance? It's like, okay, so you don't have any money. Is that what you're trying to tell me? I think there's a lot of stuff on the internet these days, you know, how to buy a business with no money down. It's sort of, they're taking the real estate model and transferring it into buying businesses. And I mean, it's high risk for the buyer, high risk for the seller. My goal is obviously to get the seller as much cash on close as possible. And yes, we do a lot of seller financing deals, but it's typically sort of the inverse of what, you know, if a buyer is thinking, well, I'll put down 10% and have the seller finance 90, or the banks and the seller finance 90, it's typically the inverse. The deals we see are typically the buyer and the bank puts up 80 or 90 and the seller will finance a certain portion just to make everyone happy and get the deal done. But that's probably the other biggest gap that I see in my practice.
And what I'm famous for in my own mind maybe is this whole idea of buyer competition. You buyers, if you have buyer competition, you're handing over advantages to the playing field. Just think about that. Now, the way you get around that is what? Be the preferable choice. And we can talk about that some other time. And no other gaps, Stephen, for now?
Oh, yeah, that's it for now.
Okay. Hold on. Everybody needs to have their video off and their microphones muted, please. Okay. I've saved her for last. It's our lawyer, Nancy Fallon-Houle. And why is she last up in this panel? Because it's lawyers who usually and wrongly are last to hear what they need to hear during deal making. Now, I've known Nancy since 2016. She works out of the Chicago suburbs, 24 years running her own firm. She's handled numerous kinds of business transactions, including M&A. And one of the things I like most about her is she writes legal documents in plain English. Nancy, what can you tell us about gaps?
I have two gaps. One is the valuation gap, which David has already addressed, so I'll make that very short. And the other is the gap between reps and warranties and the results of due diligence. So on the valuation gap, I'll just say one quick thing to buyers, and that is that buyers may need to pay for their own valuation. If you have an unreasonable seller who hasn't obtained a valuation and you have a sense that they're too high on their price, which typically sellers are unless they've obtained a valuation, then you might have to figure out your own valuation or hire Stephen or somebody to do one. On to the next, the more important gap, which has legal implications. It's the gap between due diligence results and the reps and warranties. The reps and warranties, if you can get a list of reps and warranties in advance and ask the seller the questions that the reps and warranties go to, you're going to smoke out a unstable or a bad deal way early on. Examples are reps and warranties that are affected by due diligence are I, seller, own all the IP for the company, or me and the company own all the IP, or I own all the shares, or me and my partner own all the shares. Or I use, we've created our own code and technology. I don't use any source code. So these kind of things are and I've trademarked my name. I filed a patent on the mechanism to operate the business. Any of these types of legal reps and warranties, and there are many others. I've complied with all laws. I've complied with the environmental laws and the licensing requirements. though, if you see failures in those reps and warranties, which are triggered by your doing due diligence, then you know there's going to be time delay and cost to fix them, or you might find out that the deal isn't worth doing. And due diligence occurs in stages. So there is a lot of due diligence, more on the business side, that buyers can do on their own, and sellers can prepare for due diligence on their own with checklists. And I have checklists I can share for both sides. And then there's going to be another couple of stages of due diligence. The accountant will do some financial due diligence for you. The lawyer will do legal due diligence for you. More business issues will smoke out from the results of those two due diligences. So don't omit to do your own planning as a buyer and as a seller on the due diligence results, but work with your professionals along the way, because more due diligence will come. And the deeper you go into it, the more intense the reps and warranties get. But you can do it in stages, and you can do it and make it be successful. And you can learn, hopefully early on, that a deal isn't going to work. Oh, quick thing on reps and warranties. Most of the reps and warranties are seller reps and warranties. The buyer only has basically 1 or 2 rep and warranties. The buyer says, I formed a business to purchase this one. And the buyer says, I have financing to buy your business. We talked about that earlier, so I won't go into that, but that's the only rep and warranty a buyer has, is that I have financing and I'll pay for the business as I go on under a seller note. Thank you.
You know, one of the first questions that I get from people wanting to buy a business is, how do I select the lawyer and what do I do first? Here's what I tell them. When you're interviewing lawyers, ask them if they will hand you, the day you hire them, a checklist of what are going to be the common speed bumps you're going to need to anticipate as you're looking at the particular kind of deal you're doing. And a list of what the typical reps and warranties can be really helps. That's how I discovered Nancy, by the way. On her website, she's got a ton of documents that you're able to download free that really have the kind of detail. And a lot of lawyers, maybe they just forget, but they don't present that up front. And then they nickel and dime, excuse me, their clients who are asking questions one at a time. Get that right up front. Try to get the scope of the job up front from your legal and maybe accounting too. David and Stephen, do you have any comment on this stuff?
I agree with Nancy. I was looking at reps and warranties as well, and I mean, some of them are pretty basic. Like the one I love in Canada, there's always for tax purposes, the seller has to confirm that they are not a non-resident of Canada. It's a double negative deliberately, but yeah, I mean, we had a deal that almost fell apart because the seller wouldn't vouch. The buyer wanted the seller to vouch for all unknown unknowns, like the Dick Cheney phrase. And the seller said, well, I don't know what it is that I'm signing off on. And the buyer said, well, if the seller doesn't know, then we certainly don't know. And so we had the lawyers on both sides and the buyer and the seller. And, you know, where I was in the middle trying to sort of commit, well, what are we actually talking about? And no one knew, because it's unknown unknowns. I don't know. We finally got the deal done, but it was we had to sort of accept the fact that if it's unknowable, it's unknowable.
When it comes to reps and warranties, I like to challenge people to just consider what would be the outcome if this particular thing turned out to be untrue or the warranty was violated, and what do we have in our deal to allow for some kind of a non-judicial resolution. Because I think that if your deal is set up in such a way that there are mechanical things you can, levers you can pull and switches you can fire to come to some sort of resolution without people heading towards, a courtroom, both parties lose in that situation. And so that, to me, that's the number one thing is what is the worst case if this thing is crossed? and how would we resolve that? I think that can lead you sometimes to rewording things or putting in some limits or adjustments or in some cases even changing some of the terms of the deal if it's a big enough hazard.
Non-judicial resolution. Let's not cover it now because we don't have time. David, I hope you'll keep a note of that. I think that's a huge gap and we ought to cover that in a future episode. Okay, let's sort of sum this up a little bit.
Non-judicial resolution, Ted, is money. Almost all reps and warranty failures can be covered with money. I represent that I've paid all taxes all the way back, or I have no legal litigation against me. Well, if those turn out to be not true, money comes forward from the seller to pay back the false rep and warranty. Sorry to interrupt you, Ted.
We will talk more about that at another event. Okay, folks, in a moment, I'm going to see if anybody has any comments they haven't put in the chat box. But for now, you can do better if you contact me and we build or improve your searcher marketing plan. You can learn more about searching by reading my book, How to Prepare Yourself and Find the Right Business to Buy. And my other book helps you achieve worthwhile deals, How to Buy the Right Business the Right Way. You will save time, you will save money, you will achieve better deals if you do what the savviest buyers do. I'm available to help you deploy the tactics and strategies from my books. You can get them on Amazon. So, I'm Ted Leverette, the original business buyer advocate with Partner On Call Network. Thanks for listening.